Kraft Heinz reported earnings this week. They are a bit less dynamic than Twilio or indeed Airbnb for that matter, but they had some interesting stuff in there, I think. So revenue came in at 7.38 billion, which is 10% higher compared to this quarter last year, which is, we were talking about P&G the other week, Steve, and we were saying that, look, we're expecting kind of inflation matching growth. I'm not exactly sure what inflation is in the States at the moment, but it's not 10%, and it's barely that in this country. They break their revenue into North America and everywhere else. North America was up 9%, everywhere else was up 13%, and since most of their stuff comes through North America, predictably enough, that comes to 10%. Earnings per share was 72 cents versus they were strictly loss-making last year following some write-downs and that kind of thing. They offer you an adjusted EPS to try and make them comparable a little bit, so they take out the non-cash charges effectively. And that was about 8% higher on 10% higher revenues. So they're guiding for $2.67, $2.75 per share in EPS this week. That puts it at a price-earnings ratio of around 15, so it's not terribly expensive, at least probably not compared to some of the other things that we've seen in this kind of defensive sector that looks like it's in fashion a bit at the moment. But given inflationary pressure, I thought that wasn't bad. They had a 15% price hike and then 5% loss of volume, getting you to sort of 10% growth in revenues, and that I thought that was okay for a company that Morningstar says doesn't have a moat either. They're currently attempting to find savings to increase efficiency, and this is a thing that has been a historic problem for Kraft Heinz. They got into deep trouble around the sort of 2019 mark by fairly ruthlessly swinging the axe at anything that wasn't immediately considered essential and ruining their brands as a result, and everything went through the floor. That's why that stock did terrible and everyone thinks it's Buffett's worst investment. It's not his worst investment, might be the worst one he still has. The stock's done very badly, but I think there's decent opportunity here, so they're now kind of more carefully looking at reinvesting and trying to maintain their margins and rather than trying to grow them at all costs. And their total debt, which is the thing that I always watch on this company, because I have this idea that they are quietly bringing down their debt and they're going to eventually flip their way back to either a bigger dividend or perhaps more likely some buybacks along the way. Everything's been steady on that front for since about 2019 now. Total debt's come down by another 8% since the end of the previous quarter, I think. So they continue to chip away there, and that to me is encouraging. I thought this was a sneaky good report that's likely to go under the radar a little bit of a sort of defensive company doing what defensive companies are meant to do. Market didn't care. The day after, it behaved sort of broadly in line with what the rest of the market did. I think it was down slightly, but so was everything else. So and nothing outsized there, which, yeah, that kind of caught my eye as one that was doing different things to what we said about P&G, Steve.
Interesting that it's growing above inflation, because these companies are really designed not to. They're meant to just kind of trace it. But yeah, interesting. I did help them out. I bought a little jar of salad cream over the weekend. It's been a very long time since I've had salad cream, and it's about £3.50 now, and it's very small. So I definitely felt the effects of inflation being pushed onto
That'll
the consumer.
That'll be the 13% everywhere else thing. They did mention strong growth in the UK, actually, I think.
Yeah, but perhaps I paid off that 8% of debt with my little bowl of salad cream. But is this one you own, Steve? I always forget if you own this one or not.
I do. I attempted to get Paul to own it a while ago without much success, but I do own it, yes. It's about 7% higher than it was where I bought it, which feels like a lot for that company, and I still think it's probably decently valued, and if I didn't already own it and have a nice green number at the bottom of my screen next to a load of other red numbers, I'd probably still be buying it here.
It's one of those tough stocks for me, because I think it's one of the stocks that if I owned it and it got to about sort of 10 or 12% in a short period of time, I think it'd be on the chopping block. But
yeah, I've thought about it.
Yeah, I guess I don't have a lot of faith in these sort of companies to return, make amazing returns every year. But it seems to be doing all right for you, Paul. Kraft Heinz, it pays a dividend. Why don't you own it?
It's the retail margins, isn't it? I'm not quite there. You can't expect these companies to go up much more than inflation, like you said. Your expected return really is 2% minus the dividend, so maybe 4% or something like that. And that's the only reason. I don't think it's a bad or good. Defensive really important to have in your portfolio. I'm just not great at the food here. I think I said if I was going to do a very basic dividend portfolio, I would probably go with Mondelez or Kraft Heinz, just because they're the two Cadbury owners. That's basically it, really. Just looking Applied Materials have just released really good earnings. Looks like that's going to go well. Semis are back.
Steve? What drove the 10% then? Did they mention what was driving the extra?
Yeah, price
extra?
hikes basically. Hiking prices
Pricing
by
power is
about
the thing,
15%, and that dropped off with 5% less in volume, but on balance that comes out as ahead effectively. And there's always a game with this of trying to figure out exactly what the market will bear in terms of price hikes. And it looks like they slightly overdid it in terms of, well, maybe, all right? I mean, who knows? If you hike by 12, maybe you still lose 5%. Maybe that 5% was never coming back anyway.
You'd take that every day of the week, wouldn't you? If you,
I think so.
Sell 5% less, but at 15% more, that seems like a win-win in almost every scenario.
Yeah, operating margins are around 20% at Kraft Heinz, by the way. I thought that was sort of reasonable enough.